Real estate is one of the most popular investments around the world, not just as an investment, but obviously for lifestyle. I think it's as you become wealthier, probably the main thing that you can keep spending money on to make your life just better and have a cool place to be. And obviously there's a ton of Americans who own real estate. However, there's many tens, hundreds, I don't know, maybe tens of hundreds, thousands, millions of Americans who would like to have property around the world. However, as an American, buying real estate around the world can have various different consequences to it. In the US, you get all sorts of cool benefits like 1031 exchanges, you can get depreciation, etc. And today I'm going to talk to you about if you're an American who wants to buy real estate around the world, what are the tax consequences you need to look out for, what are the things that are going to work well for you, and how should you plan in that process. So looking forward to talking about it. If you have any questions, put them in the comments below. Thank you for being here. I'm Michael from Offshore Citizen. And if you would like help with any of the topics that we are talking about here, which is relocating abroad, getting residencies and citizenships, doing international investing, lowering your global tax, doing international banking, please reach out to us. You can book a call with me, calendly.com/Michael-Rosmer. There's a link in the description below, or you can send a message through offshorecitizen.net. Again, there's a link in the description below. So with that in mind, please smash the subscribe button, hit the all notification bell, and let's get started. Okay, so as I mentioned in the intro, real estate is a really tax-advantaged asset in the US. You have the ability to benefit from depreciation, you get to benefit from deferral in the asset itself, and you get to benefit from 1031 exchanges where you can potentially roll the asset over into another asset and not pay tax in the middle. You can write off mortgage interest, and you're in a situation where when you eventually sell, you pay capital gains rates. So all of that makes it pretty attractive. Add to this the fact that probably the cheapest, easiest, most secure loans that a person can get are in a mortgage. And so as a result, going and being able to buy a property can turn out to be a really good strategy for someone, both from an investment standpoint, in terms of earning rental income, having a renter pay your mortgage, while benefiting from capital appreciation on levered money. Lots of benefits. Not that I would necessarily say that now is the best time, depending on where you are, although again, real estate is a hyper-local asset, but it is an asset that over time has been pretty good for a lot of people. Now, what happens when an American wants to go buy in another part of the world? Let's just say, for instance, I was just talking to a client the other day who was buying property in Turkey. Okay, American person buying real estate in Turkey, buying real estate in some places in Europe. And so what are the consequences they're going to face? Well, the first thing to note and understand is anytime you purchase real estate in another country, you don't just have American taxes to worry about, you also have to worry about the local taxes. So in this particular case, Turkish tax, or if you were to buy in Italy, Italian tax, if you were to buy in Ireland, Irish tax, if you're to buy in UAE, UAE tax. And so both of those need to be considered. So that's the first thing. And so today I'm going to talk mostly about the US side of it because every country is different. Some countries there's no tax, some countries there's lots of tax, some countries there's wealth tax, so you have to sort of plan as you go along. Anyway, from an American standpoint, the first thing to understand is if you're paying tax in that country, so for instance, you buy a property in some other country and they tax you on the rental income, you have to file your taxes on that income in the US as well. Even though the property is not in the US, you're taxable on your worldwide income. So you're going to file tax, you're going to include that rental income in your US taxes. You will be able to take advantage of write-offs and all the normal stuff from a US perspective, and you can get a tax credit for taxes paid in that country. This goes for both the capital gains and the earned income tax. So in other words, the earned income tax being on the rental income, if you sell, the tax would be on the capital gain. The challenge that you may run into is something like wealth tax. Typically there's not an equivalent to in the US, and so if there's wealth tax in that case, you typically will not be able to get a tax credit. So very, very important to understand how that factors in. Next thing to consider after having set up, okay, yes, you've got taxes in the foreign country, but you do get to, or taxes in the US, but you get to offset the one for the other. So you shouldn't be double taxed, right? You should be, basically you'll pay the higher of the two taxes in that scenario. Well, the next thing that is worth considering is what about in terms of your ability to defer? In the US, if you were to go and sell a property, you can put the money into escrow for a 1031 exchange. You can then go and use the money in a new purchase within about 18 months and end up in a situation where you didn't have to pay tax on the sale, which allows you to kind of keep rolling the money over potentially perpetually as you go into a larger and larger property. Very, very great prospect. So the way that it works is Americans can use 1031 exchanges on foreign properties as well. So let's use this client in Turkey, for example. They sell their property there. Now, Turkish rules aside, they're going to be in a situation where they would have a capital gain in the US, but they can benefit from a 1031 exchange. However, that 1031 exchange can only be used outside of the US. So you can't cross over, you can't take money from a US-based 1031 and roll it into a foreign property, and nor can you take a foreign 1031 and roll it into a domestic property, okay? Very, very important. Just quickly, for those who aren't familiar, imagine you were to sell a property for $1 million, say you'd paid $500,000 for it. You would have had a capital gain based on $500,000. So if you had to pay a 20% tax on that, you're losing $100,000, which means you only have $900,000 to go into the next property. That's why the 1031 is nice, because then you have $1 million to put into the next property as opposed to $900,000. And this has a lot of benefit from a tax standpoint long term in terms of growing wealth, but also frankly is just more convenient in terms of being able to go into the next property and consider changing your lifestyle, etc. It's sort of designed practically because it's literally what's called a like-for-like exchange. Okay? So very important to realize that. So in other words, this can be useful for you if you're going to go and do repeated investing within a foreign country. So let me give you an example of where this would be useful. Say you invest in a country where there is no capital gains tax. Okay, so you buy a property, it appreciates in value, you decide to flip it and go into some other properties. Maybe you're buying at a discounted price, you're renovating, you're fixing them up, you're pushing the value up, you're holding for a little bit of time. Now you roll it over into the next purchases. Well, that's really useful if you're going to continue to do that internationally. If you're not going to continue to do it internationally, you're going to be hit with the capital gains. So in other words, my recommendation to somebody who is going to be going into foreign property is ideally to do it in a country where you're going to likely be doing this over a long period of time. If you're just going to do it for, a quick flip and then move on to, back to the US, and you're not going to do more property internationally, then it doesn't really make so much sense. So I would say if you're thinking, where should I buy? Think places you're looking at long term if you're wanting to go down this road. Now, the next thing you need to consider is mortgages, okay? So it will typically be much more difficult for you to get a mortgage in a foreign country than in your home country. It's just the way that it goes. They don't have such an ability to come after you in terms of credit rating. In fact, often they don't have credit ratings in those countries. You're in a situation where they can't verify your income the same way. They can't go after your income if there's some issue. They can't bring legal enforcement against you. They maybe can take the property per the mortgage, but that's sort of the limit of what they can do. And as a result, banks view this as more risky and are less likely to go and offer you that loan. You still can, sometimes at worse interest rates, sometimes with shorter amortization periods. It really depends country by country, and some of them are quite good, but certainly not all of them are quite good, okay? So very important to realize that. What about in terms of the mortgage interest? So again, each country, in terms of its local tax, will have its own local way of dealing with that. For a US taxpayer, you should be dealing with the same US tax rules you would deal with regardless, so you do have an ability to claim write-offs, etc. However, you are going to be in a situation where, again, you may have to have a much higher cash share involved, and again, you have to consider both sides. Again, you're probably going to end up paying the higher of the two taxes anytime this is the case. Also, in some of these countries, they don't have the same depreciation rules. So the US has really favorable depreciation rules. So domestically, you may not find you get those same depreciation rules. And that could mean that what you thought was a really good investment based on US rules is not such a good investment based on the other country's rules. So also worth considering that. Again, country by country basis, okay? Very, very important. The last thing that I would leave you with that I think is worth understanding is When you are doing this, you're going to find that a lot of the structures around purchasing real estate that you rely on in the US do not necessarily exist in many other places. For example, the titling system may not be as well organized. It may not be as easy to find out if a property is solid. It may not be as easy to go after people if there's some sort of a defect or a problem, etc. This isn't true for all places. Some are fantastic. Some have much better systems than the US. But I do think it's really important anytime you're looking at investing in foreign countries to understand that the rubrics that you're used to could be different. Now, depending on where you're coming from, that could be better, could be worse, but definitely worth understanding that this foreign real estate does have some trade-offs. You can very rarely go to US banks to get mortgages on foreign properties. That's not normally something they will do just because they're not willing and able to easily enforce the claim. And because of that, when you're dealing with the foreign bank, you're probably dealing in the local currency, which means that you're going to be subject to currency fluctuations. So you could have it that, for example, you're investing in, let's say, Switzerland, and the Swiss franc goes up relative to the US dollar. This could effectively mean in US dollar terms your mortgage just went up. Now, granted, probably the property did as well, but this is fairly important to consider. And it can get even worse if you're getting a mortgage in a loan or in a denomination that is not the currency of the country that you're in. This was pretty famous in Serbia, for example. They came along a number of years back and offered people Swiss franc mortgages. I believe it was Swiss francs. Anyway, one of the foreign currencies. And we're told that, oh yeah, it's much better to take this. And a lot of people took that foreign denominated mortgage. Well, it turned out that the Serbian dinar crashed and the people were left on a relative basis with a much higher loan. So be cautious of how currencies are involved. All those things said, I think it can be really excellent because you can buy properties in really wonderful places and you can kind of expose yourself to different global markets, environments. When something is up in one place, it could be down somewhere else. And so you get some sort of diversification. And on top of that, you can enhance your lifestyle and maybe find some really cool opportunities. So if you have questions, put them in the comments below. Again, hit the subscribe button, select the little bell that dings there, and I'm going to look forward to seeing you on the next video.